You've probably seen the headlines by now. Some version of Mexico shuts down silver exports or global silver supply about to collapse. Thumbnails with arrows pointing straight up. Words like shock, crisis, and once-in-a-generation opportunity. And if you've been around this market for more than a few cycles, your first instinct is probably a mix of curiosity and skepticism. That's the right instinct to have. Today I want to slow this conversation down, strip out the hype, look directly at the data, and talk calmly about what Mexico's proposed silver export restrictions actually are, what they realistically could do to the silver market, and just as importantly, what they almost certainly will not do. This isn't a call to panic buy. It's not a call to dismiss the story either. It's a call to understand it. If you're new here, welcome to Financial Briefing. This channel exists for exactly this kind of moment. When the headlines are loud and the emotions are high, our job is to be quiet, analytical, and accountable. No clickbait, no promises, just probabilities and a framework for decision making. Let's get into it. Before we look forward, I want to look back for a minute, not because past performance guarantees anything, but because accountability matters. About 8 months ago, when silver was trading around $24 an ounce, we said that the market was undervalued relative to industrial demand, but that price would likely remain capped until real. Yields softened. The result? Silver chopped sideways for months, then moved into the high 20s only after yields rolled over. That call wasn't perfect on timing, but directionally it played out. Earlier this year, when gold broke above 2100, we said silver would likely lag initially rather than explode higher immediately, despite what some channels were saying at the time. That lag did happen. Gold led, silver followed later, and with more volatility. And in late spring, we discussed the possibility of a supply narrative emerging around base metals and, by extension, silver, tied to Mexico's mining policy rhetoric. At the time, we said it was a risk to watch, not a certainty. That risk is now being repriced by the market. Some of those calls worked, some were early, and some are still unresolved. But the point is, we track them and we own them. Now let's talk about the actual data behind this story. First data point. Mexico produces roughly 23% of the world's mined silver. In absolute terms, that's about 6,000 metric tons per year, give or take, depending on prices, investment cycles, and regulatory conditions. That makes Mexico the largest silver-producing country globally, ahead of China and Peru. Historically, Mexico has been a stable supplier to the global market for decades. Even during political shifts, output disruptions have tended to be incremental, not catastrophic. What does this number mean? It means Mexico matters. Any policy change that affects even a fraction of that production deserves attention. A 10% reduction in exports from Mexico would represent roughly 2 to 3% of global annual supply. In a market that's already running a structural deficit, that's not trivial. But here's what it doesn't mean. It does not mean that 23% of global silver is suddenly disappearing overnight. No mines are being shut down en masse. No ports are being blockaded. What's being discussed are export controls, licensing requirements, and higher domestic retention of silver, not an outright production ban. Second data point. The global silver market has been in a physical deficit for 4 consecutive years. In 2024, that deficit was approximately 200 million ounces. That sounds enormous, and in absolute terms it is, but context matters. A large portion of that deficit has been absorbed through above-ground inventories, particularly in ETFs and private holdings accumulated during the last decade. What does this mean? It means the system has been able to function despite deficits, because there was inventory to draw from. That buffer, however, is shrinking. Visible inventories on major exchanges have been trending down, not collapsing, but declining steadily. What does it not mean? It does not mean that the market is out of silver. It doesn't mean industrial users can't source material. It means the margin for error is thinner than it was 5 years ago. That's a very different statement from imminent shortage. Third data point, Mexico's domestic silver consumption is relatively small compared to its production. Estimates suggest that less than 15% of mined silver is consumed domestically for industrial, jewelry, and investment purposes. The rest is exported largely to the United States, China, and India. What does this mean? Any serious effort by Mexico to retain more silver domestically would require either building out domestic industrial demand rapidly or stockpiling silver at the state level. Both are possible, but neither happens instantly. What does it not mean? It does not mean that all exports stop. Even under aggressive policy scenarios, exemptions, phased implementation, and negotiated carve-outs are likely. Governments tend to move slower and with more compromise than headlines imply. So with that foundation, let's talk about the bullish case, because there is one, and it deserves to be stated clearly. 1. A partial export restriction from Mexico could tighten an already deficit market at the margin. Silver is a small market relative to gold. It doesn't take much incremental demand or supply disruption to move price. A 2 to 3% reduction in global supply could have an outsized price impact, especially if it coincides with rising investment demand. 2. Industrial demand for silver continues to grow, particularly from solar, electrification, and electronics. These are not speculative uses. They're embedded in long-term infrastructure plans. Even if substitution occurs over time, it doesn't happen overnight. 3. Silver tends to lag gold and precious metal cycles and then catch up aggressively. If gold remains firm above $2,000, capital rotation into silver is a reasonable expectation. 4. Narrative matters in markets. Even a modest policy shift can change psychology. If investors begin to perceive silver as geopolitically constrained, not just economically scarce, risk premiums can rise. Taken together, the bullish scenario is plausible. Not guaranteed, but plausible. I'd assign about a 25% probability to a genuinely bullish outcome where silver sustains prices above $35 and challenges the low 40s within 12 to 18 months. Now let's talk about the bear case, because ignoring it is how people get hurt. First, policy announcements are not policy outcomes. Mexico has discussed resource nationalism before. Implementation has often been slower, softer, and more negotiated than initial rhetoric suggested. Markets frequently price the announcement, then fade the reality. Second, higher prices incentivize supply elsewhere. Recycling increases. Marginal mines become viable. Silver is not rare in the geological sense. It's constrained economically, not physically. Third, demand destruction is real. At higher prices, industrial users thrift, redesign, and substitute. Solar manufacturers, in particular, have been actively reducing silver load per panel for years. Fourth, macro conditions still matter. If real yields rise, or the dollar strengthens materially, silver can struggle regardless of supply narratives. In this scenario, the Mexico story fades into the background, silver remains volatile, but range-bound and prices drift back toward the high 20s. I'd put the probability of this outcome around 30%. Which brings us to the middle case, and this is where I personally land. The most likely scenario, in my view, is not a dramatic export ban or a total non-event. It's a gradual tightening of regulatory oversight, some friction in export flows, and a modest but persistent supply premium priced into silver. Prices grind higher, not explode. Volatility increases. Silver trades between $30 and $38 for an extended period, frustrating both bulls and bears. This outcome aligns with how commodity markets usually respond to political risk, slowly, unevenly, and with a lot of noise. I'd assign this scenario about a 45% probability. To understand why that's my base case, it helps to look at history. A useful comparison is not a silver-specific event, but resource nationalism episodes in other metals. Think about copper policy shifts in Chile or rare earth export controls from China in the early 2010s. In those cases, prices spiked initially, then retraced, then settled into a higher range as the market adapted. The similarity is the narrative shock. The difference is market size and substitutability. Silver has more substitutes than rare earths, but fewer than copper in some applications. That puts it somewhere in the middle in terms of long-term price impact. Now zooming out to cross-market context. Gold remains firm, holding above $2,000 despite relatively high nominal yields. That tells you something about underlying demand for monetary hedges. The dollar index has been range-bound, not collapsing, not surging. That's a neutral to slightly supportive backdrop for silver. The 10-year yield has come off its highs but remains elevated. That caps speculative excess but doesn't kill the trade. Put together, cross-market signals are not screaming boom, but they are quietly supportive. Positioning data reinforces this. Commercial hedgers remain net short, as they usually are, but not at extremes. Managed money positioning in silver futures is elevated but not euphoric. This is not a crowded trade yet. So what am I doing with this information? Here's my framework. Not advice, just my framework. If silver pulls back toward $30 while the Mexico narrative remains intact and macro conditions don't deteriorate, I'm adding incrementally. If silver breaks and holds above $38 on volume, I let existing positions run but don't chase. If silver loses $28 decisively, I reduce exposure. Currently, precious metals make up about 15% of my portfolio. Of that, roughly 9% is gold, 4% is silver, and the rest is miners. My stop loss on new silver adds is around $27.50. My take profit zone on a portion of the position is $42 to $45, with the remainder held as a long-term hedge. What am I not doing? I'm not panic buying. I'm not watching fear-driven content all day. And I am not assuming that this is the end of the financial system wrapped in a silver story. This week, here's what I'm watching. 1. Official policy language out of Mexico, not headlines, but actual regulatory text. 2. Silver ETF flows. Sustained inflows would confirm investor demand. 3. The gold-silver ratio. A decisive move below 70 would signal silver strength. To wrap this up, 4 takeaways. Mexico matters, but nuance matters more. Silver's fundamentals are tightening, not snapping. The most likely outcome is higher volatility, not immediate moonshots. And disciplined frameworks beat emotional reactions every time. If this kind of analysis helps you think more clearly in noisy markets, consider subscribing. That's how you support this channel and this approach. Thanks for watching Financial Briefing. Stay sharp.